If you have long-term financial goals such as retirement, you need to consider the effect that inflation can have on your investments. A financial planner can help you create a diverse portfolio that can beat inflation. Shares of businesses that can raise their prices to offset inflation tend to perform well. Technology and communication services are examples of such companies. Stocks, a diversified portfolio of stocks, offers a good chance to beat inflation over the long term. Stocks typically have beaten rising prices by an average of 11% over the past decade when dividends are reinvested. However, you'll need to invest early and stay invested for the long haul. Many investors find this difficult, especially during volatile times. The best way to beat inflation is to invest in companies that can generate solid earnings even when prices are high. These companies should also have low capital needs and can reinvest profits into their business to keep profits growing. Investors will reward these businesses by purchasing their shares at a lower price-to-earnings ratio than others, which may help to offset the effects of inflation. Bonds are another asset that can help to combat inflation. However, if inflation is high, what appears to be a solid return on a bond may actually turn into a negative real return. This happens because rising inflation reduces the value of your purchasing power over time, which in turn reduces the yield on your bond. When you're investing for long-term goals, stocks and stock mutual funds are probably the most effective ways to beat inflation. Consult a financial planner to discuss your particular investment needs, time frame, and risk tolerance. Inflation can be scary, especially when you're saving for retirement. Many investors are overly optimistic about the inflation-adjusted returns of their retirement portfolios, according to a 2023 survey by Natixis. The stock market has beaten inflation on average by more than 9% over the past century, but you'll need to stick with your plan through high inflationary periods and other gyrations in the market. Commodities investing in commodities can be one of the best ways to beat inflation. These raw materials are publicly traded and can be a powerful hedge against inflation because they tend to rise and fall independently of stocks and bonds and have low correlations with other asset classes. In addition, they are often highly durable and have a long history of being used as currencies. For example, gold was the currency of choice for the Silk Road traders and the Vikings. It has also been a source of wealth and strength for many civilizations. In addition to traditional commodity markets, investors can buy and sell them via exchange-traded funds, ETFs, or mutual funds that provide exposure to specific commodities. Purchasing hard commodities like metals and energy commodities can diversify your portfolio, but it is important to understand that these investments can be very volatile. Again, they can also be difficult to store or transport, which makes them more vulnerable to weather events and political events that can impact supply. Soft commodities are agricultural products that can be a useful inflation hedge. These include corn, wheat, sugar, and soybeans. They are commonly sold on derivative commodity markets through futures contracts. Purchasing these commodities through ETCs can be more convenient and cost-effective. Real estate is another tried-and-true inflation hedge, and research has shown that it will profit from rising prices. It can be challenging to find and manage a property, but you can invest in it indirectly by buying shares of real estate investment trusts, REITs. These companies own and operate commercial and residential properties and pay their dividends directly from rental income. These companies have a high track record of beating inflation, but they can be volatile and may not perform well during periods of unexpected inflation. Bonds investors are often advised to hold a significant amount of cash in their portfolios as a way of protecting against inflation. However, in a high inflation environment, holding too much cash can be counterproductive. As inflation rises, cash can actually lose purchasing power. In addition, withdrawing money from the market can actually depress long-term investment returns. Instead, you can better preserve your buying power and still earn a good return on your investment by investing in securities that can outpace inflation. Bonds are one of the most conservative investments you can make. Specifically, government bonds provide relatively low yields, but their principal values appreciate as inflation rises. Treasury inflation-protected securities, TIPS, are a good example of this type of investment, and they can be found in 5, 10, and 30-year maturities. However, TIPS are also subject to interest rate risk. If interest rates rise, real bond yields will increase and can potentially outpace the inflation adjustment provided by TIPS. In addition to traditional bonds, you can also invest in a variety of other inflation-resistant assets. Some of these include real estate and commodities, while others are more unique and less conventional. For instance, you could use a diversified crypto portfolio to earn interest and possibly even beat inflation. Collectibles like trading cards, comic books, and artwork may also be able to hold their value in an inflationary environment. As a general rule, stocks that benefit from inflation tend to be businesses that require minimal capital and are not dependent on natural resources such as technology or communication services. Currently, the S&P 500 has a significant concentration of these types of businesses, so it might be worth diversifying your portfolio with exposure to these sectors in order to beat inflation. Real estate inflation is a significant risk for investors as it erodes the purchasing power of their assets over time. However, there are several investments that can help you beat inflation, including real estate, TIPS, and certain dividend-paying stocks. These investments are often referred to as inflation-proof or real return investments. Talk to a financial advisor for advice on how to incorporate these investments in your portfolio. Real estate is a classic hedge against inflation, as property values tend to rise in tandem with general prices, and rents can be raised to offset the impact of rising costs. However, it's important to note that these investments are not without risk, and their performance can vary depending on market conditions. For this reason, it's essential to diversify your investing portfolio with other inflation-resistant assets. Another way to protect against inflation is to invest in a diversified portfolio of stocks. Companies with strong growth prospects and low debt levels are likely to thrive in inflationary times as they can increase earnings and pay out higher dividends. You can find a variety of stock index funds that target inflation-resistant stocks, such as the S&P 500. These funds typically have high concentrations of technology businesses and communication services, which are capital-light industries that should be less impacted by inflation. Government bonds are also a good option for protecting against inflation, as they offer an annual interest payment that is adjusted to reflect inflation. These bonds are called Treasury Inflation-Protected Securities, TIPS, and they provide a safe and reliable source of income that can outpace inflation over the long term. However, you should be aware of the risks associated with TIPS, including liquidity risk and interest rate fluctuations. Social Security inflation is an important consideration for investors, but beating inflation requires discipline and a long-term mindset. It also requires a well-diversified portfolio. Covenant Wealth Advisors can help you make smart choices to beat inflation. Social Security has built-in inflation protection in the form of annual cost of living adjustments, CIOLAs. Whenever a government measure of consumer prices increases from year to year, Social Security benefits rise by an equivalent percentage. This protects retirees' purchasing power from rising inflation, which can be devastating for those on fixed incomes. However, the restrictions placed on Social Security investments have prevented it from achieving this goal. By requiring that Social Security's reserve accumulation be invested only in risk-free Treasury securities, the system denies workers a return on their investment. that is close to the average of private investment returns, which are about 6% more than inflation. These restrictions have contributed to the popularity of reform proposals that claim to offer painless ways to increase Social Security's viability. But these proposals are not addressing the real problem that the trust fund's investment in risk-free bonds has created. These low yields have made it more difficult to balance future payroll tax increases and benefit cuts, which will be necessary to ensure Social Security's solvency. The solution is to remove the limits on Social Security's investment options and allow it to invest in a diversified portfolio of private assets. This would increase its return over inflation and reduce the size of future benefit cuts and payroll tax increases. The move would not impact national saving, investment, capital stock, or production, and it would not generate large deficits. It would, however, significantly improve Social Security's return on investment.